Not every customer who generates high sales is actually profitable. Some customers order frequently, pay on time, require very little support, and create steady income for your business. In this video, you'll learn how to calculate customer profitability using a simple and practical approach. Customer profitability is the process of measuring how much profit a single customer actually contributes after every cost of serving that customer has been considered. Many business owners stop their analysis after looking at sales revenue because it is the easiest number to find. Unfortunately, revenue tells only part of the story. A customer who spends a large amount of money can still reduce your overall profitability if serving that customer requires excessive resources. Imagine a wholesale business with two regular customers. Customer Alpha places large orders throughout the year and appears to be the company's best client because total purchases are very high. However, this customer constantly negotiates discounts, requests urgent deliveries, changes orders at the last minute, asks for customized packaging, frequently contacts customer support, and often delays payments. Every one of these activities increases operating costs. Now compare that with customer Beta, who spends less money but orders predictable quantities, accepts standard delivery schedules, pays invoices quickly, rarely contacts customer service, and almost never returns products. Although customer Beta generates lower sales, the business spends far less money serving that account. The result is that customer Beta may contribute significantly more profit than customer Alpha. This example highlights an important business lesson. Revenue measures how much money comes into the business, but profitability measures how much money actually stays in the business after expenses are paid. Companies that focus only on revenue often invest more time in customers who produce the smallest financial return. Businesses that understand customer profitability can identify which relationships deserve additional attention, which customers need different pricing, and where operational improvements can create immediate financial gains. Calculating customer profitability begins with gathering accurate financial information for each customer over a selected period, such as 1 month or 1 year. The first number you need is total revenue generated by that customer. This represents every sale made during the chosen period. Next, determine the direct cost of providing the products or services sold to that customer. These costs normally include inventory purchases, manufacturing expenses, raw materials, or direct labor required to produce the final product or complete the service. When you subtract these direct costs from revenue, you calculate gross profit. Gross profit is an important starting point, but it does not represent the customer's true profitability because many additional costs remain hidden. You must also consider expenses that exist specifically because you serve that customer. These may include shipping costs, sales commissions, customer support time, technical assistance, installation services, payment processing fees, warranty claims, product returns, travel expenses, promotional discounts, and the cost of collecting overdue payments. After subtracting these customer-specific operating expenses from gross profit, the remaining amount represents the customer's actual profit contribution. The formula is simple to understand. Customer revenue minus cost of goods sold minus customer-specific operating expenses equals customer profitability. Even a basic spreadsheet can perform this calculation accurately if you consistently record the necessary information. The goal is not perfect precision on the first attempt. The goal is developing a clear understanding of which customers create the strongest financial results and which relationships quietly reduce your overall profitability. The easiest way to understand customer profitability is by walking through one detailed example from start to finish. Imagine you own a small office furniture company that sells desks, chairs, and storage cabinets to businesses. One of your customers, Green Valley Consulting, has purchased products from your company throughout the year. According to your sales records, this customer generated total revenue of $80,000. At first glance, the account looks excellent because the sales volume is much higher than many of your other customers. If you stopped your analysis here, you might assume this is one of your most profitable relationships. However, customer profitability requires looking beyond revenue. Your accounting records show that the direct cost of manufacturing and purchasing the products sold to Green Valley Consulting was $50,000. After subtracting those direct costs, the gross profit equals $30,000. Many businesses celebrate this number and move on, but experienced business owners know the calculation is only beginning. During the year, the sales representative spent many hours visiting the customer and preparing custom quotations. The customer requested several urgent deliveries that increased transportation costs. Multiple products were returned and replaced under warranty. Customer support handled frequent calls about product assembly and installation. Because the customer negotiated special pricing, additional discounts reduced the final selling price. The finance department also spent considerable time following up on late invoice payments. When all of these customer-specific costs are added together, they total $12,000. Subtracting those additional costs from the gross profit leaves an actual customer profit of $18,000. Now imagine another customer with lower annual revenue but very few service costs. That customer could easily generate a higher profit despite purchasing less. This example demonstrates why smart businesses never evaluate customers using sales revenue alone. Profitability always tells the more complete story because it reflects both income and the resources required to earn that income. Once you begin calculating customer profitability across your business, interesting patterns quickly appear. Some customers consistently generate strong profits because they order efficiently, communicate clearly, pay invoices on time, and require very little support after each sale. These customers often become the foundation of a financially healthy business because they create reliable profit without consuming unnecessary resources. Other customers may seem valuable because they place large orders, yet their behavior creates hidden expenses that slowly reduce overall profitability. They may request frequent order changes, demand custom work, expect immediate responses at all hours, negotiate aggressive discounts, or regularly delay payments. None of these actions may seem significant on their own, but together they increase the total cost of serving that customer. This is why businesses should review customer profitability regularly instead of assuming every customer contributes equally. The objective is not to remove customers immediately. Instead, the goal is understanding what makes each relationship financially successful. Sometimes a simple pricing adjustment, improved ordering process, minimum order requirement, or clearer service policy can transform a low-profit customer into a profitable one. Businesses that measure customer profitability gain the confidence to make decisions based on financial facts rather than assumptions. They stop rewarding customers who consume excessive resources and begin strengthening relationships with customers who create long-term value. Over time, this approach increases profit, improves operational efficiency, and helps the business grow in a more sustainable way. Customer profitability is much more than a financial calculation. It is a decision-making tool that helps you allocate your time, money, and resources where they create the greatest return. Once you know which customers generate the highest profits, you can design strategies that strengthen those relationships. You might introduce loyalty programs, offer early access to new products, assign dedicated account managers, or provide faster service to your most profitable customers. These investments often produce excellent results because they focus on customers who already contribute meaningful value to the business. At the same time, customer profitability analysis helps identify accounts that require improvement. Instead of immediately increasing prices or ending the relationship, you can look for practical ways to reduce the cost of serving those customers. encouraging larger order sizes, simplifying product options, reducing unnecessary custom requests, introducing online self-service support, or improving payment terms can all lower operating costs while maintaining customer satisfaction. Small operational improvements made across several customers often produce a much greater financial impact than searching for additional sales alone. This is why many successful businesses review customer profitability every few months, rather than only at the end of the financial year. Markets change, customer behavior changes, operating costs change, and profitable customers today may not remain equally profitable in the future. Regular analysis ensures your business decisions continue to reflect current financial reality rather than outdated assumptions. Businesses that consistently monitor customer profitability become more efficient because they understand exactly where their profits are being created and where unnecessary costs are reducing performance. The most successful companies understand an important truth that many business owners overlook. The goal is not simply to attract more customers. The goal is to build more profitable customer relationships. Revenue creates growth, but profitability creates financial stability. When you calculate customer profitability on a regular basis, you stop making decisions based on guesswork and begin managing your business using reliable financial information. Every customer becomes an opportunity to learn how your business creates value and where improvements can increase long-term profit. Over time, these insights lead to better pricing decisions, stronger customer relationships, more efficient operations, healthier cash flow, and higher overall business performance. Customer profitability analysis does not require expensive software or advanced financial knowledge. It simply requires the discipline to measure both the money coming into the business and the costs required to earn that money. Businesses that master this habit gain a powerful competitive advantage because they understand not only who buys from them, but also who truly contributes to their long-term success. That knowledge allows owners to grow with confidence, protect their profits during challenging economic conditions, and build a business that becomes stronger with every smart financial decision. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.